Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, January 5th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with number one, which is today's key macro event. Which is just the December jobs report confirms our expectation for the resiliency of the U.S. economy to begin dissipating in Q4. Number two, the nuance is we believe this report reduces the probability of the no landing scenario in favor of both the hard and soft landing scenarios. In our opinion, that is why bonds failed to continue selling off after the initial spike in yields on the average hourly earnings beat. And number three, the market implications. When analyzed with the proper scrutiny and expertise, it is easy to conclude that the December jobs report represents the first evidence of a period of below trend growth some members of the Fed believe is necessary to seal the deal on inflation and contribute to the soft landing via rate cuts. Market participants are not yet in possession of leading evidence that can ascertain whether the period of below trend growth evolves into a period of contracting growth. Thus, we still feel betting on the hard landing scenario as one's modal outcome is imprudent. Transitioning to our 42 macro dashboard here. So we're getting some oversold, overbought signals here. Overbought signal in the 10-year nominal treasury yield here. Getting an overbought signal in terms of our Loanbow trading ranges from our friends over at Loanbow in the 10-year tips yield as well. Getting a near oversold condition in the S&P 500 here. We're getting a near overbought condition in VIX futures right there, are actually overbought in the VIX futures there. And then NASDAQ futures oversold as well. Russell 2000 oversold as well. So it looks like the market was very much anticipating that hot average hourly earnings beat, but we got some monkey wrenches thrown into the data for those of us who are analyzing things well beneath the surface in terms of ushering in what could potentially be a period of below trend growth in the labor market and for the broader U.S. economy. In terms of transitioning to our 42 macro aware community, we got a question here from our read through of the ISM manufacturing print. So the question reads, to push the hard landing narrative, some talking heads are flagging the following chart, which shows the number of industries reporting overall growth in the ISM manufacturing survey. They're flagging that chart as sort of a bearish indicator. I'm going back to reading the question now. It says, I totally understand that this is a single data point, but how should we ingest this input versus your Goldilocks setup? Thanks for all your great work. So the quick answer to that is, when I look at a chart, a single plot chart, my brain always thinks about, okay, what's happening in asset markets in those particular years. I have a pretty photographic memory for most asset classes in terms of how they evolved over the course of time. And when I see the lows of this chart being in 2001, 2003, 2009, 2012, 2016, 2020, and then now 2023, my initial reaction, citing that, that photographic memory is, markets have rallied sharply off the lows of this chart. And obviously, with the statistic declining to one in terms of the number of industries reporting overall growth, it's obviously not going to decline below zero. So we're probably close to a cyclical low on this particular indicator. So it's going to bounce and recover over the near term, although we continue to expect a gradual recovery in the domestic manufacturing sector as this kind of rolling recession, rolling recovery theme starts to play out in full force throughout 2024. So in our opinion, this is a bullish setup for asset markets over the medium term, because again, ultimately it means we're probably at the cyclical lows of what has historically been a leading indicator for some pretty powerful returns in the equity market. Doesn't necessarily mean we're going to get powerful returns in this particular cycle. We're just using this as an overlay or as an input to our broader qualitative research process. So we'll wrap it up there. Darius Dale presenting our macro minute for Friday, January 5th, 2024. Best of luck out there today. We'll catch back here on Monday. And for those of you who are subscribers, the smartest people among you, we'll have our macro scouting report presentation out this afternoon, our January 2024 macro scouting report. Definitely going to want to check that out in terms of some of the very important signals that we're catching from the labor market in this December jobs report. So we'll see you guys this afternoon for that, for those who are behind our paywall. Cheers.